You followed the playbook to a T. You went to university, landed a stable job, and you're diligently contributing to your retirement account every single month. You're doing exactly what your parents told you to do. Work hard, save 10%, and the gold watch will be waiting for you at 65. On paper, you're the definition of responsible.
So why does it feel like you're falling behind? Why does it feel like the more you save, the further the finish line moves away? That feeling isn't a lack of discipline. It's pattern recognition. Because the financial map your parents handed you wasn't designed for the world you actually live in. It was designed for a world of high interest rates on savings, defined benefit pensions, and a housing market that didn't require 40% of your gross income just to put a roof over your head. The exact advice that made them comfortable is the same advice that is quietly making you poor, not through a sudden crash, but through a steady, invisible erosion of your purchasing power month after month. According to recent data, 68% of millennials and Gen Z are on track to have a lower standard of living in retirement than their parents. But here's the secret nobody wants to admit. Most of these people aren't failing because they're buying avocado toast or being lazy. They're failing because they are falling into retirement traps disguised as safe, traditional wisdom. They are playing a game with 1980s rules in a 2026 economy. I'm going to walk you through the structural traps that are swallowing your wealth, not the obvious ones like gambling or bad stocks, but the sneaky ones. The ones your parents, your HR department, and your local bank manager tell you are smart. These are the traps currently draining your future without you even realizing it. This is not financial advice. I don't know your specific ledger, but I do know that the first step to escaping a cage is realizing you're inside one. Let's start with the first and perhaps most dangerous trap. Trap 1. The safe. Savings trap. Your parents grew up in an era where putting money in a high-yield savings account or a certificate of deposit actually meant something. In the early 80s, interest rates peaked at nearly 15%. You could literally get rich just by letting your money sit in a bank. But today, the safe path is actually the most dangerous one. When you factor in real-world inflation, not just the official CPI, but the actual cost of things you need like healthcare, education, and housing, your safe savings are losing value every single day. If your bank is paying you 4% and real-world inflation is 6%, you aren't saving money. You are paying a 2% wealth tax for the privilege of feeling secure. The bank's definition of safe has nothing to do with your wealth. To a bank, safe means your principal doesn't fluctuate. But to you, safe should mean your purchasing power is protected. By following the just save it advice, you are essentially hoarding a melting ice cube. The trap is the psychological comfort of seeing a static number in an app while the world around you becomes 10% more expensive every year. Trap 2. The 401k tunnel vision. Your parents saw the 401k as a miracle, and for them it often was. But the trap for you is tunnel vision. The traditional advice is, max out your 401k and don't look at it for 40 years. Here is what that advice ignores. Liquidity and opportunity cost. In 2026, the average household has less than $2,000 in liquid cash, but has $50,000 trapped in a retirement account they can't touch without massive penalties. This creates a devastating cycle. Because your wealth is locked in a tax-advantaged cage, when a real-life emergency happens, a medical bill, a car breakdown, a job loss, you don't have the cash to cover it. What do? You turn to high-interest credit cards or personal loans. You are literally earning 7% in your retirement account while paying 22% on your credit card debt. That's not a strategy. That's a math error. Your parents' advice to never touch the retirement fund only works if you have a massive cash cushion. Without that cushion, your retirement contributions are actually making you more fragile, not more secure. You're 401k rich and Tuesday morning broke. Trap 3. The starter home delusion. Buy a house as soon as you can. Renting is throwing money away. This is the holy grail of parental financial advice, but in today's market, the starter home has become a wealth-stripping trap. In 1980, the median house price was roughly 3.5 times the median household income. In 2026, in most major hubs, that ratio has ballooned to 8 or 10 times income. When you buy a starter home today, you aren't just buying a house, you're buying a massive front-loaded interest obligation. For the first 10 years of a 30-year mortgage at current rates, almost 80% of your monthly payment goes toward interest, not equity. Add in property taxes, insurance, which has spiked 30% in the last 2 years, and the hidden maintenance costs that your parents always forget to mention, and suddenly, renting looks like a bargain. The trap is believing that a home is an investment first and a shelter second. If your mortgage, taxes, and maintenance eat up 45% of your take-home pay, you have no margin to invest in assets that actually grow, like equities or your own business. You are tied to a specific location for a starter house that might take a decade just to break even after closing costs. Your parents' advice worked because their houses appreciated 500% while their wages grew. For you, the house might just be a very expensive box that keeps you from ever being able to afford retirement. Trap 4. The degree at any cost fallacy. Get the best education you can. It pays for itself. This was true when a year at a state university cost the same as a used Honda Civic. Today, the cost of higher education has outpaced inflation by more than double. The trap here is the normalization of student debt. We've been told that $100,000 in debt at age 22 is a good investment. But let's look at the compound cost. If a 22-year-old enters the workforce with a $1,000 a month student loan payment, they aren't just losing $12,000 a year. They are losing the most valuable years of compound interest in human history. That $1,000 a month invested in an index fund from age 22 to 30 would grow to millions by retirement. Instead, it's going to pay off a degree that, in the age of AI and rapid skill obsolescence, might have a shelf life of only 5 years. Your parents' advice doesn't account for the fact that the ROI on degrees has fundamentally shifted. Following this advice blindly is starting a marathon with a 50-pound backpack and wondering why you can't keep up with the leaders. Trap 5. The loyalty penalty. Your parents likely worked for 1 or 2 companies their entire lives. They were rewarded with seniority, pensions, and stability. Naturally, they tell you, keep your head down, work hard, and the company will take care of you. In 2026, this is a financial death sentence. Data shows that workers who stay at the same company for more than 2 to 3 years earn 20% to 50% less over their lifetime than those who job hop. The loyalty your parents value is now used by corporations as a tool to keep wages stagnant. While the company is posting record profits, your cost of living raise of 3% is actually a pay cut in real terms. The trap is the psychological safety of the familiar. By staying loyal, you are missing out on the single biggest wealth-building tool you have in your 20s and 30s, the income jump. Every year you stay in a stagnant role because it's safe is a year you are choosing to remain poor. Your parents' advice protects your ego, but it destroys your balance sheet. Trap 6. The diversification. Myth. Over-index on bonds. Your parents likely tell you to balance your portfolio. As you get older, the traditional wisdom says you should shift more of your money into bonds and safe fixed-income assets. The classic 60-40 split. In the 20th century, this was brilliant. Bonds paid a real yield above inflation. But in the current economy, the bond trap is a wealth killer. With global debt at record highs and central banks forced to keep rates in a specific Goldilocks zone to manage that debt, bonds often provide a return of capital rather than a return on capital. When you over-diversify into low-risk assets in your 30s and 40s because your parents are worried about a market crash, you are committing the sin of opportunity cost. You aren't protecting your wealth, you are amputating its growth potential. In an era of high monetary debasement, the only real safety is in productive, scarce assets. Playing it safe, according to a 1990s retirement brochure, is exactly how you end up with a portfolio that looks fine on a screen, but buys half as many groceries as it did 5 years ago. Trap 7. The good debt. Brainwash. A mortgage is good debt. A car loan is fine if the rate is low. Rate. A student loan is an investment. Your parents' generation categorized debt into good and bad. But in 2026, debt is debt. Every dollar you owe is a claim on your future labor. The trap is the normalization of monthly payments. We've become a society that doesn't ask, how much does this cost, but rather, can I afford the monthly payment? Your parents might see a low-interest mortgage as free money, but they aren't factoring in the fragility factor. When you are leveraged to the hilt with good debt, you lose the ability to take risks. You can't quit the job you hate to start a business. You can't move to a new city for a massive promotion. You are a debt slave to a lifestyle that your parents told you was the American dream. The secret to wealth isn't managing good debt, it's owning your time. Trap 8. The retirement age mirage. 65 is the magic number. This is the most insidious trap of all because it's a psychological anchor. Your parents lived in a world where you could reasonably expect to retire at 65 and live another 15 years. But today, healthcare is extending lives while the cost of that care is skyrocketing. The trap is building a financial plan based on an arbitrary age. If you plan to retire at 65 based on your parents' math, you are likely underestimating your burn rate by 40%. You aren't just saving for a 15-year vacation, you're saving for a potential 30-year period of unemployment where your medical costs will be the highest they've ever been. The retirement age is a mirage that keeps you from working with urgency now. If you assume you have 30 years to figure it out, you'll spend your 30s and 40s drifting. The reality, you need to build a work-optional lifestyle as fast as possible because the safety nets your parents relied on, like Social Security and corporate pensions, are being stretched to the breaking point. Trap 9. The wait your turn. Philosophy. Your parents believe in the hierarchy. Work your way up the ladder, wait for the senior VP to retire, and your time will come. In the digital economy, waiting is losing. The wait your turn trap prevents you from seeking asymmetric upside. While you're waiting for a 5% raise at your corporate job, someone half your age is using AI to run a lean outbound agency or a localized YouTube empire that generates 5 times your salary. The secret to viral wealth in 2026 is realizing that the ladder is broken. Your parents' advice to be patient is often just a recipe for obsolescence. In a world where technology moves this fast, your most valuable asset isn't your seniority, it's your agility. Don't wait for a seat at a table that's being disrupted. Build your own table. Trap 10. The busy trap. The final boss. This is the trap that binds all the others together. You are so busy following your parents' safe advice, working the long hours, commuting from the starter home in the suburbs, managing the good debt payments, that you have no time to actually think. Your parents view busyness as a sign of a productive life. But in finance, busyness is often a smokescreen for a lack of strategy. If you don't have 4 hours a week to look at your wealth map, you aren't a hard worker. You're a pilot flying through a storm without looking at the radar. The busy trap ensures you never notice the cracks in the foundation until the house is already leaning. It keeps you in default mode, following the path of least resistance, which happens to be the path your parents laid out 40 years ago. The escape room. Here's the hard truth. These traps aren't your parents' fault. They gave you the best map they had, but they were mapping a different continent. The retirement trap is structural. The banks, the universities, and the lifestyle industries all profit when you follow the old playbook. They want you in a 30-year mortgage. They want you with a 401k you can't touch. They want you busy and loyal. Escaping doesn't mean you stop saving. It means you stop saving blindly. It means prioritizing liquidity over locked accounts until you have a real floor. It means viewing your home as a cost, not an investment, until the math proves otherwise. It means aggressively increasing your income through skills, not just waiting for seniority. It means realizing that safe is the new risky. The ground isn't just shifting. It has already moved. Your parents are looking at the old horizon. You need to look at the one in front of you. If you're in your 20s or 30s, you have the greatest asset in the world, time. But that time only works for you if you stop spending it on a script that was written before you were born. Stop walking toward the cracks. Start building a life that doesn't require a gold watch to be considered a success. You aren't failing the system. The system's old advice is failing you. Once you see the traps, you can finally start walking the path around them. The path is open. You just have to be willing to walk it.